Hey there and welcome to the channel. In today's video, we are going to be looking at a company that is pretty interesting and I've had on my watch list for some time. The company is called OTC Market Groups or Over-the-Counter Market Group. Now, over-the-counter is something that you might connect to penny stocks, which is correct, but the company certainly has a lot more to it than just the penny stocks, which we will see in this video. And in the video, we are going to be going over my checklist, which contains 117 items. Of course, we won't be going over all of them, but I'll show you the main highlights, and we will then end the video by giving the company a total score. But before we get into it, I do want to ask you to smash the like button and subscribe to the channel if you haven't already. That is to say, if you get any value out of the content that I'm providing on the channel, and also leave me a comment below if you are invested in OTC Market Group or thinking about investing. So what does OTC Markets actually do? Well, it's not a complicated business model. They operate the OTC QX Best Market, which are the most high quality companies. Then you have the OTC QB Venture Market, which are lower quality companies, but still pretty good. And then you have the pink open market, which is also called the penny stock market. And as we can see here, the company generates about 85 to 90% of its revenue through a subscription-based model, which is something that we like to see. So they basically have three businesses: their OTC link, their market data licensing, and their corporate services. Now, since we are looking at a write-up from Value Investors Club from 2020, these percentages are not correct. We'll take a look at them later in the video. The OTC Link is a trading system where broker-dealers pay subscription and usage fee related to the number of quotes and messaging volumes. And the OTC Link gets more revenue based on market activity. So you can imagine the company making the most money through their OTC Link when there's a raging bull market. Then you have the market data licensing, which is also a subscription-based model where users subscribe to licenses for market data, compliance data, company data, and security information collected by the company. And the company has some pretty high-profile clients like Bloomberg, Reuters, FactSet, and Nasdaq. Then you have the corporate services where they have their three markets, the OTC QX, the QB, and the pink sheets, where the companies pay for their application and an annual or semi-annual subscription fee. Now, the company is a relatively high moat business where they have these really strong relationships with the broker dealers. Once they are on the platform, they are very likely to stay there. And they have very strong relationships with the high profile clients that I mentioned. And the company is becoming more profitable as it grows since the operating cost base is largely fixed, which should provide for substantial operating leverage as the company gets bigger. And the biggest operating cost for OTC is personnel related, which is 65% of the operating costs. So what are the key competing businesses for OTC? Well, they are the bigger markets, the New York Stock Exchange and the Nasdaq. However, they aren't real competitors in my opinion, since I don't think there are a lot of companies contemplating on if they want to join the New York Stock Exchange or OTC. What usually happens is that a smaller company will list on the OTC, and once it gets big enough, it will graduate, or what they call graduate, from the OTC markets and join the big boys on the New York Stock Exchange or the Nasdaq. So let's compare these three companies, OTC, Nasdaq, and the New York Stock Exchange, which trades under the symbol ICE. Now, OTC is the only company out of the three that has negative free cash flow in the last year. But if you look to the 3-year and the 5-year free cash flow growth, OTC beats both the Nasdaq and the New York Stock Exchange. If you look to valuation, the Nasdaq and OTC have a similar valuation if you look at the enterprise value to free cash flow, while the New York Stock Exchange is the most expensive one. Now, I was a little surprised when I looked at the comparison between the three companies. When you look at return on invested capital, return on capital employed, and the return on equity, where you have OTC just in another league compared to Nasdaq and New York Stock Exchange. If we compare the margins of the three companies, New York Stock Exchange has the highest margin and the Nasdaq the lowest, with all of the three companies having pretty stable margins. Again, the New York Stock Exchange has the highest operating margin, but is the only one that has an operating margin that's going down for the past 5 years. But OTC actually has the lowest free cash flow margin of the three, but 26% is still pretty good. Now, when it comes to comparing the balance sheet, OTC has no debt, so they do have the strongest balance sheet. And we can see here that the New York Stock Exchange has very little cash compared to their debt. None of the three companies have been diluting shareholders to a meaningful extent. But you can see the difference in size here, where the New York Stock Exchange is a $70 billion company, the Nasdaq $31 billion company, and OTCM only 677 million. If you compare the revenue growth, we can see that all three companies have had a pretty slow year, where OTCM has the most growth of 5%. And overall, they have been beating the Nasdaq and the New York Stock Exchange for the 3-year revenue growth and the 5-year. The next thing I highlighted in connection to the competition is how does OTCM differentiate itself against other companies in the industry. Now, they are cheaper alternatives for companies that can't afford or are too small to go public on the bigger exchanges, like I mentioned earlier. But there are also some bigger foreign companies that want to list there because there are lower fees and there are less information that they have to give to the public and therefore less information that they have to give to their competitors. Now here we can see the revenue composition for the company from their latest earnings report in November, where OTC Link is now 17% of revenue, the market data licensing is 41%, and corporate services is the biggest source of revenue for the company at 42%. Another thing that I highlighted on the checklist is if the business has any pricing power. In my opinion, they do have pricing power where they can raise their annual fees on the companies that are listed without having too much problems. But fortunately, the management team is thinking for the long term and they are focusing on the customer retention rate, which was about 95% in 2022 compared to 96% in 2021. So the company isn't planning on raising prices in the near term. And that is something that gives them what is called untapped pricing power. The next thing that I highlighted on the list is if the business is threatened by regulators or something like antitrust. That is something that, of course, can be a big risk for the company since they are operating in a very regulated finance space where changes in policies from the SEC or FINRA could increase the cost of running the business. And in my opinion, that is the biggest threat to the growth of the company. But if you read through the annual reports and the earnings call transcripts, you can see that the company seems to have a good relationship with the regulators and they have decades of experience in dealing with them. And the goal of the CEO, Cromwell Coulson, is to increase regulation of the OTC market and with that increase the market reputation. Like we saw earlier, the company has a really extraordinary return on invested capital and return on capital employed. But that's not worth much if the company isn't able to reinvest the money that it's making. So my next question is, where is capital being reinvested? Now OTC bought Blue Sky and the Edgar database, and they are paying both the dividend and the special dividend, and are doing some small share buybacks. Now Cromwell has stated that he would want to make a similar acquisition to Blue Sky 5 times a year and try to acquire bigger companies. We will talk about that in more detail later in the video when we go over the highlights from the earnings transcript. The next question that I have is where are the opportunities for new product lines or growth in existing ones? In my opinion, the biggest opportunities are in getting more non-US companies to list on the OTC because I do think there is a big advantage for a lot of companies to list on the OTC and get access to American investors without having to disclose all of the things they have to disclose on the New York Stock Exchange and the Nasdaq, and also pay lower fees. So what industry metrics measures the business performance? What are the key performance indicators or the KPIs? Now the KPI for OTC Link, which is the smallest revenue source for the company, is of course the volume and the average daily trades on the link. And at the top of the last bull market, they almost reached 100,000 daily trades, but that number has been declining ever since and is now getting close to 20,000. But of course, if Jerome Powell is going to start to lower interest rates, we might see this line go up again. For the market data licensing, subscribers are of course very important, and the company has seen a healthy growth in their subscribers when it comes to professional users, but the number of non-professional users are declining, and we can actually see lower numbers than 4 years ago. It is a similar story with the corporate services, where the key performance indicators are, of course, the subscribers on the markets, where the best market now has 595 companies, which is down 2% year over year. The venture market has 1,166 companies, which is down 6% year over year. And the pink market, 1,496 companies, which is down 5% year over year. So after going over these couple of things, I think we can understand how the business works, and we can see that they do have a competitive advantage or a moat. Now, the next thing to look at would be the management team of the company, and we are going to look at insider ownership, where Cromwell Coulson, the CEO, and his family have about 37% ownership. And Cromwell actually bought the company back in 1997. Now, I like to go to glassdoor.com to find out more about the culture of the company from the employees and what they are saying about the CEO. Now, we only have 28 reviews, but OTC is a small company, so that is something to expect. But the company gets 4.3 stars and 100% would recommend to a friend, where the CEO gets a 89% approval rating, which is pretty good. And you really get the sense that Cromwell Coulson is a high quality CEO with a lot of integrity when you read through the earnings transcript, where Cromwell says that the company must be good stewards of the business to serve clients and help our colleagues succeed, and that the company must act as sharp commercial operators in managing their resources carefully, and to be fiduciaries for the shareholders to deliver sustainable financial results that will increase the underlying value of each individual share. And the company also doesn't make forward predictions, which is something that high quality CEOs like Warren Buffett and Mark Leonard of Constellation Software don't do. Now, Cromwell seems to be modeling himself after Warren Buffett, which is really positive to see, where he thinks that every public company CEO should read The Outsiders. Now, The Outsiders is a really good book, and I would recommend it personally. But Warren Buffett has also recommended the book. And finally, we can see his thoughts on the organic growth side, where he has thought of himself, or the company has thought of itself in many ways, like Buffett, who will buy very good companies that serve their clients well, and then he sucks all the capital out and reinvests it in other businesses. And Cromwell is saying that he has very skilled shareholders, where he pushes out the dividends from the company, both through the regular dividend and the special dividend, and the shareholders are able to allocate that capital better than he can within the company. That is something that I personally don't agree with, since I do think that he is a much better capital allocator than probably most or all of his shareholders. But he is also talking about the company being in the second stage now, where they are getting bigger, so they have some scale to be able to deploy capital efficiently in acquisitions. And with the acquisition of the Edgar database and Blue Sky, they have started in small places, so they won't blow up or sink the ship if they make a mistake. So over time, Cromwell is planning on adding in profitable opportunities and getting better at acquisitions, which in my opinion is a very good strategy to use the strong free cash flow of the company to buy more companies. So before we end the video by giving the company a total score, we are going to try to evaluate the intrinsic value of the company and we are going to use the DCF calculator on Guru Focus. And if you use a discount rate of 10% and a 10% growth for the next 10 years, then a 4% growth into perpetuity, the fair value of the company would be $41, where the stock price is currently at $56. So obviously, according to a DCF calculation, the company is nowhere near the buy zone. But you could also argue that a company like OTC, which is very high quality, has very little competition, and very good management, is a company that you would want to pay up for. But that is something every investor has to answer for himself. But if you think about it in a fundamental way, the company is generating about 27 million of free cash flow each year, and they do have a market cap of about 650 million, maybe around 630 million if you deduct the cash, and they have no debt. So the enterprise value would be 630 million. And the company is very likely to be able to grow 10% for the next 10 years. So you have to ask yourself, if you had 630 million, would you buy the company? So to wrap things up, the company gets a very high total score of 92 out of 117, which is one of the highest numbers that I've seen when using this checklist to analyze companies. But to sum up the analysis, the company is very predictable. They do have a business model which is easy to understand. They have a competitive advantage against other companies in the business. They have what is called a very wide moat. The company is seeing a healthy growth in both revenue and free cash flow, and they do have great returns on invested capital and return on capital employed. They have a lot of cash and no debt, and a very high quality management team with a CEO that has 37% ownership of the company and therefore a lot of skin in the game. So, in my mind, there is no question of the company being high quality. It's just a question of the buy price. But hopefully, I'll be able to soon add OTC to my portfolio of high quality companies. But only time will tell if that happens or not. But that's it for the video today. Remember to like and subscribe if you haven't already. I want to thank you for watching, and I will catch you on the next one.